Hi, and very good evening to all the attendees here. First of all, Ramadan Kareem, very welcome to all of you to this webinar. This webinars, these were a series of webinars which were started in the mid of the March, and we have carried it on to April, May, and we continue to do this throughout this entire quarter. Given the fact that a lot has happened in last few months, it has not been a happy situation for anyone. So we have come up with an idea that as much as we can assist to the clients, to the prospects, it will be better. And this series of webinars will continue in many different topics, where we will cover what is happening right now with the markets, how you can navigate easily from the uncertain times, which, like now, and maybe in the future will face some more uncertainty. So how to deal with it. Okay. My name is Yogesh. I'm a global investment strategist in Century Financial. And before we start, on behalf of the entire team of Century Financial, myself would like to thank all the first responders, doctors, midwives, nurses, anyone from the healthcare sector. If you are into the healthcare industry, if you have any relatives, friends, husbands, daughters, wives, anyone who is out there risking their lives, thank you so much. Um, Congratulate you for staying at home and staying safe. I hope everyone here is in good health. Now, to start with, today's topic is to learn how to navigate the uncertain markets. Markets, let's understand this thing. Markets are always, it has always been uncertain. It is the volatility which plays an important role. I conducted a webinar yesterday also, and I talked a bit about volatility index. I'm not sure how many of you attended that yesterday, but today also we're going to talk initially about what the volatility index is. And first and foremost, that is one of the important uh, gauge to check how volatile the markets are. Okay, so I will be taking questions in between as well. So you have a chat window open. Your questions will be directed to me directly. If you have, please, any questions regarding the markets or any doubts, if I'm able to clear it, I'll do it right away. If there is something which I'm not able to answer, I will surely talk to my research guys and get back to you on it. So keep asking questions. We'll read from the chat and we'll try to answer as much as we can. So first, we'll talk about what has happened of lately. We all know that the coronavirus pandemic has hit the stock markets. The excess oil supply has hit the oil market, the energy market. There has been excess oil, plus there has been a slump in demand due to coronavirus pandemic. The manufacturing is down. The entire economies are suffering. So during this time, where to invest, what to do, and first and foremost, how to handle yourself in terms of investments. Because a lot of things must be going inside your minds. Should I enter now? Or if you have already invested, must be thinking, should I buy or hold it? Should I keep holding my investments or I book my loss? So this session is going to tell you a bit of history about how market has worked before, the bear and bull trends, also what is the psychology of the investors and how you can take advantage of it. Similarly, we if anybody here who's not able to hear it properly, or if there's a technical issue, if you're not able to properly go through with this, do not worry. Just speak to your RMs, and we can have a one-on-one personalized session as well. Okay, we'll see what time slot is available, and we can reach you out, and we can have a one-on-one session where I can demonstrate you how the platform works, how to do buy sell, how to diversify in these markets, which are the current opportunities also, right? So without further delay, let's try to understand first, what does volatility means. Okay, now when we talk about volatility, we need to understand, first of all, the market risk. So the fluctuations which happens up and down, consider that as volatility. If volatility is high, which means market is moving really fast, really a big gap. So for example, if gold is moving $30 high and $30 low at the same point, you see the markets are more volatile. Now, let's try to understand how volatility is measured. So the Chicago Board of Exchange, which is the one of the largest exchanges in US, they have come up with something called a volatility index. And it's not from now, it's from a long period of time. People have been trading into volatility index. Volatility index, it's like a fear gauge, which measures the movement of S&P 500, the US stock market index, the rate at which it moves, high and low. So if you see the two charts which I'm showing it to you here on the presentation, you can see since February 28, around 60 countries reported coronavirus cases, and we saw a big dip, a big decline in the stock markets. So the red line is Dow Jones, which is also called US 30, and the red line is US 30, and the gray line, which you see almost parallel with it, is S&P 500, which is another US stock market index. So these indices, they have taken a big decline after when we saw the coronavirus cases when they increased. Now, if you can also see the decline in these indices right here, and then see the volatility index. So volatility index, I will show you on the platform also that there is a future contract for volatility index which can be traded, which moves up and down, which you can do daily trades also in. The volatility index is kind of inversely proportional to S&P 500, which is your US market. So if you see here, the markets came down and the volatility index, it went up. And this is just not now. So I'll share a chart with you and just see it for yourself. Right now, what you see is a chart, a very thin line chart of the volatility index whenever it has peaked. So if you see these green lines, this is whenever it has gone high and then again it has come down. So if I were to mark it, let's say if I can make a circle rather here, right? This is where volatility index has peaked here, here, and then this, and then this is 2020, which is this. Now, the interesting fact over here is every time the volatility index peaks out, and when I say peaks out, that means whenever it goes to a certain point and comes down, normally we have seen that the markets, they start recovering. And when I say recovering, doesn't mean it shoots up exponentially. Recovering means that is where you see that, okay, markets might have bottomed out and the crash which was decline which was happening, maybe this is it. After this, it will bounce back. But when I say bounce back, doesn't mean to the pre-crash levels. Maybe it goes up a bit and then again comes down, again goes up a bit, again comes down, but that level where it crashed. So basically, to identify the bottom, you can easily check the volatility index. It doesn't mean that it is a sure shot understanding that now markets have bottomed out and I should enter, but it gives you a really good gauge to measure the bottom of the market. Okay, because many investors, they have this question, okay, there's a possibility market is going down further. Why should I invest now? Maybe it might come down further, right? See, you can never time the bottom. Nobody can. I cannot, you cannot. It is impossible to time out that, okay, this is the bottom, let's buy now. There will always be that risk. So volatility index helps you understand, and it also helps you uh, understand the point that if it is going higher and higher and it's continue to go high, maybe the markets will fall down because there's an inverse relationship. There's a negative relationship between the US index and the volatility index. I will show you one more chart. Clear this. If you see next, now this is also a chart of volatility index, but over here, what I have done, I have shaded, let me just close this. Now what I have done here is I have shaded the gray areas here with the gray, the recession points. So if you see the first point over here, this entire point here, this is 2001, right? So you see a big dip over here. And when I say dip, that means if you see over here, this was a peak, right? So if volatility index was at a peak, you saw that over here, when the 2001 dot-com bubble happened, markets crashed. Then if you see another point, this is 2008, the infamous crash of 2008. We saw volatility index peaked there, and then when it came down, markets recovered. And there has been countless points. If you see it here also, if you see it here also, all these times markets have crashed and then recovered, right? These some small peaks. This is between 2018, right? When the trade war was happening, we saw a market dip here. So volatility index peaked up. This is 2020. Again, it peaked up here, and then you now see this coming down, right? So this is one understanding to observe, that for those investors who are still thinking, should I go here? Should I invest now? Is this the right time to invest? See, you cannot always bottom out, but with the help of volatility index, at least it will tell you that there is a probability that the worst crash which had to happen happened. Now from here, slight recoveries will happen. There will be dips also, because there is no vaccine to the coronavirus pandemic yet. So we will see declines, we will see a downside also. But maybe right now, the worst crash which happened in February, it went up and it went up. Okay. Somebody asked me, what does it mean for an investor when the volatility index has peaked? Good question. So what does it mean for an investor when volatility index has peaked? When you say the word peaked, that means it has gone up and now it has started coming down. So for an investor, it is an indication that maybe now is the time to enter into the market and start taking the buying position. That is what it means if the volatility index has peaked. But we use the word peaked in reference to the point when it has peaked and it has started coming down. So when it has started coming down, that's a kind of indication that S&P or US index will start moving higher. Okay, so because there is an inverse relationship. Now, similarly, so this was 2008, this was 2001, this is 2020 right now. So these are few hotspots which we can always check, and your advisors can assist you with understanding the volatility index also. You can trade also into the index. If markets are crashing, index will go higher, so you can be on the buying side of it. So there is a way that you can trade into it, right? Now, moving on. Now, this is where we have to understand, so where we started from, to understand the markets. If we want to navigate in uncertain markets, first we need to understand uh, the psychology of the investor. What happens in a bear market? What happens in a bull market? Right? So those who have joined right now, we have just started with a brief. We are going to understand how the investors' psychology work. See, guys, what you see right now, it's a hypothetical market cycle. Okay, it is not something which shows the historic data. This is just for illustration purposes, right? If you can see, there is a market peak and there is a market bottom and then again a market peak, right? When market goes down, when there is a crash, we call it a bear market. When it recovers, there comes a bull market, which is on the higher side. Now, the market volatility, it can cause very serious anxiety for investors. Okay, but it also creates an opportunity. Now there is anxiety. So normally, whenever there is an anxiety about something, there is an opportunity there. Right now there are a lot of companies, lot of stocks, good companies, which are down because of the pandemic. But again, there is an opportunity, right? If you look back and if you see that how the stock markets have behaved in previous market cycles, it's very simple. You look at the past and then you try to understand uh, what are the prospects of the future. So if you try to understand the previous market cycles and just try to compare what is happening today, you will at least get a right answer. at least some answer to what is happening. Now, this particular chart, it is, if you can say, it is very easy to spot the market peaks and the bottom right here. But it is very difficult to remember when you are living through the market cycle. Now, right now, you all have a question that, okay, this chart, what I'm showing it to you, it already points out what is the market bottom, right? There, here it is the bottom, left side there's a peak, right side there's a peak, because this has already gone through. We are not in it right now, but what we are in is the current market cycle, right? So yeah, fair enough, it is very difficult to point this out, but what we'll do is we'll go a little back and try to understand how the bear and the bull markets have survived. So first thing what we observed was that the bull markets, which means when the market starts going higher, the bull markets, they tend to be stronger than the bear markets. Okay, how it is? So first you understand the stock performance. So every shares, most of the stocks and the stock markets, they are cyclical in nature. So you must have seen first, if there is a crash, then there's a recovery, acceleration goes up, and then it decelerates, and again the growth diminishes, and then there's a recession. Bear markets, when we talk about bearish markets, can be caused by when stocks get overvalued, if there's a geopolitical conflict, recession, monetary policy, markets come down on these things, right? Uh, a market drop of 20%. So this is a very important thing. Please remember this. A drop of 20% or more over a 2 month period or longer is called a bear market. Okay. So when the markets reach to a point when investors starts buying again, that's where the recovery happens. So if there is a drop of 20% or more over a 2 month period, it is a bear market. Okay. Until this people start buying, investors start entering into again, that's where we see the recovery. Similarly, if you see a bull market, which means if there is an increase of at least 20%, we are entered into a bull market, right? So this 15 to 20% thing, always remember this. Although the market has been really volatile in past 2 months, we have seen almost a 40% decline and again a 20% recovery. So there is a lot happening. As I said, we are into a very different kind of market cycle. But what we'll still attempt is try to look at the next chart. Now, what you see here, over here, you are looking at the upturns and the downturns. So look at this very carefully. So where you can see the TR, that is your total return. When you where you can see the AR, this is your annual return. Okay, the source of this is Morningstar. We got some data. Now, if you see, this shows you since 1946. It shows you the performance of the bull and the bear markets, but it still excluding any performance which happened between those. So let me give you an example. 1946, for example. Okay. So if you see as a long-term investor, you will see that bear market, it happens. You will experience it no matter which cycle you are into. At least once you will experience a bear market. But if you see the previous bear markets, one here 1946, then look at 1960, then look at 1967, again here at 74, then we see 1980, 88, 89. We look at 2001 and 2002. This is when the crash happened. Again here, a 2008 crash when it happened. So whenever you see the previous bear market, we have always seen the stock market has always recovered and the upturns have been stronger than the downturns. So see here downturns and then see the upturns for the next few years. See here. So every time if you see this gray area, this is all your upturns over here, right? Here, again here. And your the black areas, these are the downturns. So if you see historically also, most of the time we have seen that bear market, you will experience it, okay? But there is always a chance that the recovery happens, and recovery happens if you see the numbers also and the percentage growth also, it's higher. Okay, somebody asked me, shall we look at investing in keeping stocks for long term or focus on short time selling in the current scenario? See, I think a part of your portfolio should already be investing into companies which are giving good dividends. So this is a period where we have seen a major downturn. And whenever you see things like this, always try to increase your exposure into stocks which gives you fixed dividend, because most of the stocks which gives you fixed dividend like Coca-Cola or ExxonMobil or Verizon, these kind of companies, the volatility, which means the movement of the prices up and down, is very low as compared to stocks like Alphabet or Facebook or Amazon, who does not give out much dividend, but their movement in the price is too much, right? So a part of your portfolio should focus on investing into companies like these, which gives you good dividend. And then a separate part of your portfolio should be dedicated, again, according to your risk profile, it should be dedicated to take advantage of short-term opportunities also. Okay, fixed dividend. So somebody asked me fixed dividend. So fixed dividend means when you buy a stock and you hold it for a certain period. So when you buy a stock, basically you're investing into somebody's business. If you're investing into somebody's business, you're taking a risk. So when some of the companies, when they see that you have invested in their business, and whenever the profits happen, a part of their profit is being distributed to their shareholders, which is called a dividend. Okay. Most of the companies, they have fixed dividend. Like for example, ExxonMobil every quarter comes out with 86 or 87 cents dividend per share. Okay. Every quarter on quarter it happens. So there are a lot of companies which provides you a dividend. Dividend can increase, can decrease, but there is a prior announcement to it. Okay. Most of the time companies try to increase their dividend, which gives a good outlook about the company. Also, I'm being asked, is the S&P 500 safe to invest now? And can you explain what is Vanguard and why it is preferred? So we will look into the ETFs also. Okay, we'll look into S&P 500 also. So we'll go through the platform where we'll understand the asset classes and we'll understand how market index works and how you can diversify your exposure into different ETFs also, right? So what we were talking about here is that the upturns of the market are much more stronger than the downturns, right? Now, again, same question. Is every pullback, so if I go back and try to understand, so this is the downturn. Now, if we understand, is every pullback the beginning of a bear market? So we need to understand what is a pullback. Bear market, we understood. If there's a 20% decline for 2 or more months, we are looking at a bear market, right? But what about the minor corrections which happen? Does it mean that it's a buying opportunity or it is crashing, right? There is always that thing. Like you will see that whenever a stock price declines dramatically, like your first instinct will be, oh, why it is crashing, why it is going down. It might go down, it might crash, right? So you have to make a very clear line. A bear market and a pullback. Pullback are these short-term corrections. It happens, profit booking happens, market gets corrected. So let's say around 5 to 10% of decline if you see. So over here, if you see a decline of 5 to 10%, it's very common. And times like this, again, with such high volatility, it's very, very common. But corrections, they do not happen as frequently as market pullbacks. Okay, correction is 10 to 20%. But when we see a pullback, pullback happens at least 3 to 4 times. So if you see here, pullback 5 to 10% decline means in a market which happens approximately 3 times, 4 times per year. Then there is a correction, which is 10 to 20% decline, happens at least once every year, most of the time. And then there's a bear market, which might come every once or 4 years, right? So now you have to understand that when we are looking at uh, a bear market, it's 20% or more. So will that be a good opportunity to buy? Because most of the companies will be available at a discounted price, and these are good companies, right? So you have to understand which market is a bear market and which is a pullback. So over here, you can also take advantage. So what happens is no one enjoys a bear market. It's like I am thinking, should I invest, should I not, should I invest and leave it? Nobody enjoys this thing. But the worst thing you can do is overreact. See, if you already have positions, hold on to it. You be very calm. Remember that a bear market can actually be a really good buying opportunity. Okay, because after such a big market decline, your stocks, most of these companies, they're undervalued. All you have to do is just find out the companies which are at a lower price, but they have a higher quality. This is not the time to go to penny stocks. That okay, let's buy this. It's a penny stock. You have to understand if the company can survive this pandemic. And there are a lot of companies. I'll give you a very good example. Boeing. Now, Boeing saw a lot of stress because travel and tourism is shut, right? So the stock is down. The question is, will Boeing survive this pandemic? Boeing is a good company. Boeing was a really good company, but will Boeing survive this pandemic? So, like this, you have to ask yourself a question. Ask your advisor that the company which I'm investing into, is it a high quality company? And high quality means the company which will this be able to survive it? So, okay, somebody asked me, is it advised to buy Microsoft and Mastercard now at the current price? So we'll discuss about dollar cost averaging, and we'll explain what happens to the stock which are at a higher price. So Microsoft is all-time high right now. So we'll understand that how to take advantage of this. Etsy Inc. and PayPal have gone up and still showing uptrends. Shall we still buy them? So I'll answer these questions once we reach to the dollar cost averaging part, right? So what we understand is bear market also gives an opportunity, but you have to stay calm. If you have trades, continue to hold it. If you do not have trades, you can enter, but please enter into good quality stocks, high quality stocks, which you think can survive the pandemic also. Your advisor can help you with it. There are reports which were being prepared last time also. Companies, good companies, which were good cash rich companies, which could survive pandemic. So those companies were also suggested, right? Now, next, what we understand, most important thing. So we understood the first, what we did, we started with the volatility part. We tried to understand how we can understand that the bottoming of the markets, that whether it has bottomed out or not. The best thing we can do is look at the volatility gauge and try to measure the performance of S&P 500. Second, we started going into the past and trying to understand what happens when downturns happens, what happens when upturns happen. And we understood that the upturns and the downturns, when we see, the upturns are much more stronger when it happens. So if there is a downturn right now, a possible recovery and a possible upturn will happen at a much higher rate, right? Then we understood about what is the difference between a pullback, a correction, and a bear market. How many times it happens? As we see that bear market happens once in every 4 years, and the decline is more than 20%. If you invest into good, high quality stocks, and that is something which can be beneficial. Okay. Now, second thing, how do you navigate from these uncertain markets? This, I'm sure everybody has heard this at least a million times. Do not put all your eggs in one basket. This is something. So I will share you one chart. I'll share that one chart with you and see this. You don't have to go very much deep into it. What I'm just trying to show you is, if you see 2008, if you see in the bottom, the worst performing assets. So we are looking at the annual returns for all these major asset classes from 2008 to 2019, right? 2020 has just started. So if you see the top of all the top performing assets from year to year. So if you see here, see 2012, just find 2012 to 2014. Okay. If you see 2012 and 2014, you will see that the global real estate over here, it was the top performing asset class. See 2012, 28%, 2014, 50%, top performing as compared to all the asset classes. But if you go back to 2008, same global real estate, which was the highest performing sector, was the lowest performing sector in 2008, right? Because the housing market collapsed. Real estate, it was the worst performing asset class. I think everybody agrees with it. Now, if you were heavily invested in real estate in 2008, your portfolio would have been gone, right? You would have lost a lot of money. Now, to predict what will happen tomorrow, you have to diversify into different asset classes. You cannot say that I will not invest into global real estate funds. Why? Because in 2008 it crashed. Because if you see 2012, that was the best performing, right? So this is how we have to understand. If you see fixed income, Fixed income in 2008 was the best performing asset, but in 2009 was the worst performing. Similarly, in 2011, it was the best performing. 2012, it was the worst performing. So diversification is needed because what is good now may not be good tomorrow or may not be good next year. So you really have to diversify into different asset classes. That's why I'm saying if you are investing, short term opportunities take advantage of. Long term buying should take advantage of. There are different ways to do it, and we'll learn all of these. Now, next, when we move, another important thing, we should take control of our emotions. Why I laughed a bit when I said it, because it's very easy to say, but it's very difficult to do it. But the emotional investing can actually take you off course, because if your emotions are involved into this, then you will end up taking a decision which may not be right at that particular point, and emotions always get the best of us. So you have to be very careful, you have to understand your situation. Do not over leverage, do not take a very high risk, but at the same time stay calm, do not overreact, don't do something which you regret later. Okay, so when we talk about the emotions, everybody wants to do one thing. They want to buy at a lower price, they want to sell at a higher price. But if your emotions are too high, you can actually do it in a very wrong way. You can end up buying at a really high price and you can end up selling it at a very low price, booking a profit. So that's why you diversify. You always diversify your assets, you always go ahead, control your emotions as well, diversify, and stick to it. Okay, we'll just see how normally an investor mind reacts. Okay, if you see this particular chart, stock market returns and the timeline. Now if you see this, and it's a very common mistake, it's not something which I don't do or you do, anybody can do this. What is happening here now? If you see, mostly how an investor would feel during this time, let's say over here, so the first line is optimism, right? So this is the time when stock markets are going up, prices are going up, investors are optimistic, they're on the buy side, right? Top of the market, you have this feeling of euphoria, this is absolutely great, I should invest more into it. Now this is the time where you should actually consider, be a little cautious. This is something which is, see, it's very common, I'm sure you must have heard it somewhere, but try to understand this. There is the optimism here, right? This is where you're feeling really good, markets are going up, prices are going up, this is the euphoric feeling which you get. This is where you start feeling, this is really good, I should invest more money. But this is the time when you should start rebalancing your portfolio, should be very cautious, should book your profits, wait for it. Like for example, try at least to close half of your trades, book some of your profits, and keep most of the trades open or half of your trades open, right? At least book some profits. You might think that, okay, I'm just going to make a lot of money, but the right thing to do will be, when everybody is buying, you have to be very cautious and try to book some profits. Because what happens when market starts coming down? Now you were feeling really good here, so you invested more. And now when you invested more, the market started coming down. Now you told yourself that, okay, you know what? I'm a long-term investor. I don't have to worry about it, right? But when it starts coming down further, now you start panicking. Now you're thinking maybe this time is different. Let's do one thing. Let's book some losses and wait for it. Now, this is where you need to understand that it has continued to go down here. You should have rebalanced here, but now you put more money here and then started coming down. And then you thought, okay, I'm a long term investor, but then it came down further. Now you are considering that maybe, this time is different. And then over here is where you surrender, where you book your losses. Now, see what happened. You bought at the highest, and now you're booking your loss at the lowest. This is where you surrendered it, right? Now, consider buying when everyone else is cautious. This is where you should start entering into a buying side, because that's where the optimism will come back. I'm sure whosoever is listening to this, one or the other time, many of you would have fell into this kind of trap. If you have invested regularly, I have for sure. We always get into emotions, get the best of us. So believe me when I tell you that you have to keep your emotions in control. You have to be very cautious. Don't be greedy. The most problematic why people lose a lot of money in stock markets, because one, not because they make a loss. That is just one thing. There are a lot of people who do not book their profits, and it's a living example. Anybody who bought stocks in 2016 and continued to hold it till 2020 would have seen that those prices came down back to 2016 levels, which means zero growth in your portfolio, right? So you need to be careful. Also, if you see good qualities of a proper investor, you need to be investing regardless of the fluctuations. Many investors, when I talk to them, they say, market is really volatile. Market will be volatile. If it is not volatile, then how will you ever enter into the market? Imagine if it was just going up and not coming down. How would anybody enter? If Microsoft is at 180 and if it doesn't come down, how would anybody would enter? So markets will always be fluctuating, they will always be volatile, but you need to enter. You need to be invested. Always select the quality investments, take professional advice. Just don't think, okay, this looks like a pretty good company and let's buy. Seek professional help. It will do good. Always diversify and please set some realistic goals. I've seen investors, there's a decent amount of profit, they will not book it. This will go way higher, way higher. Define a way higher level in your mind. Okay, because when it comes down, you will get panic. So always have these qualities. And we have seen in the past also, anytime when the investors have tried to emotionally, invest into anything, the returns have always been lower because you hold a trade for too long when it is in a loss, but then you quickly book a profit when it goes high. You have to stop doing that. Okay. Now, next, one of the most important thing, everybody is asking this question. So what is the right time to invest? The right time to invest is today. Very simple. Do not try to find a timing. There's no set timing. I told you just there is no set timing. Try to just time in. Because what happens now, those investors who try to pull their money out during volatile times, if now when market recovers, you're not there. Why? Because you have not entered because market is too volatile. So I'm not saying, first, please let me be very clear. I'm not telling you borrow money, take a loan, uh, put your children's education fund in there. Please don't do this. I'm not asking you to borrow. I'm not asking you to beg or steal money from anywhere and put into this. This is not something, investment is done with the spare money. If you don't have it, don't do it. As simple as that. But if you have it, and if you're just keeping it because market is too volatile, it is not good. Because keeping it is not going to grow. Inflation will continue to hit and your money will not grow. So you have to think about investing. So that's why even when the markets are down, and if you are not entering because it's too volatile, you might be there on the missing side of it when the market goes up. Now, why it happens is, I will share something very interesting with you. Look at this. Now, this is the return of indices, S&P 500, which is a US global benchmark index. And if you see over 1 year periods, the stock market can be really predictable, right? So the period which you are seeing right now is January 1999 to December 2019. What do we see? Look at all these trading days. Okay. S&P 500 annualized total returns 6.06%. If you had put $10,000 during this period, that would be 32,000. Again, the source of this is Morningstar. Now, if you subtract 10 days, 10 best days when the markets bounced, returns also reduce. If you minus 20 best days when the markets recovered or bounced, your return reduces. And if you minus 30 best days, imagine this, over these 20 years, if you minus 30 best days, how much it impacts your portfolio, right? So there is always a possibility that there are times when market gives a very exponential growth and you have to be there to take it. So whenever you say that, there's too much volatility, I need to be away from it, you need to be very careful. Okay. Even if there's a volatility, invest less, but do invest. You cannot be away from the market, right? Now, moving ahead, we have understood the most important thing. We have tried to understood what diversification is. We have tried to understood how the market cycles work, how we navigate from the uncertain points. We will take a practical application to the live platform also, where we understand a bit about the asset classes and how we can diversify, how to manage the risk, and we'll also take a brief outlook on about gold, oil, stocks, which are the companies which you can trade into, the share baskets also, which we have come up with. And before that, we'll just see, you need to be familiar with the concept of dollar cost averaging, because dollar cost averaging is something which everybody would have done. uh, Normally how it works is that if you see, somebody asked me about companies like Microsoft, so let me take you to the platform also. Okay, now what you're seeing right now is a live platform. Right now, us market will open in the next 14-15 minutes, right? So we will look into the US stocks also once it is open. For now, I will just open a historical chart of Microsoft and we'll try to understand how the dollar cost averaging works. You search here, go to Microsoft MSFT, and the chart opens. Maximizing it. Okay, just 1 second. I'm getting questions over here. Any recommendations to buy? Yes, we will. I will share with you some good stocks which we have recommended in the past, and just sit throughout for the next 15-20 minutes, and we will discuss about the outlook and which are the good companies we are currently looking at. How safe is event trading, and when is the next event? Next event is tomorrow. Event trading, for all those people who have not understood events. Events are basically the market news which comes every day, and it's a lot of volatility. Event trading is mostly for short-term investors. So we will look through this also. Okay. Another question. You're advising to stay invested over a longer term. Does this platform of TradeRoom allow us to remain invested without using the future options, derivatives, and CFDs? So if you have CFDs and derivatives, first, this particular platform only provide derivatives. There are future contracts, but they're in the form of derivatives. So you can always buy a stock and hold it. So there are ways that you can buy stocks, you can buy derivatives and CFDs. Just because they're CFDs doesn't mean that you cannot hold it for a long period of time. There is a holding cost, but if you see, if there is a stock which is giving you dividend, and if you hold it for 1 or 2 years, it's giving you a decent return, then holding cost is pretty much negligible because it is based on LIBOR, and LIBOR is at a very lower rate. So at this point of time, even if you want to buy CFDs and hold it for a longer period of time, and when I say, please, when I say longer term, I think I've cleared it before also. For me, longer term is not 10-15 years. For me, at this point of time, longer term can be max to max 1.5 or 2 years. Because I think we all agree with the point that longer term is something, when Warren Buffett was there, longer term was 15 and 20 years. But the volatility has increased so much and so fast right now that longer term, the definition of longer term in global markets is reduced. At least that is what I feel. So you can always hold the CFDs also, and you will be receiving dividends also on it. So that is something which you can do. Now, talking about dollar cost averaging, I'm looking at the chart of Microsoft right now. This is historical price data. If you see here, this is 10 months old. The entire 10, not 10 months old, sorry, the entire period is 10 months. If I zoom out a bit, if you see, the duration increases 2 years, right? Now, if I have to identify, Microsoft is here right now. So somebody asked me that, why should I buy Microsoft? First of all, Microsoft is it's a $1 trillion company. It's a good company. Good thing about Microsoft is also invested into cloud computing services, just like most of the other IT companies. Amazon is also investing into cloud computing. So any company which is investing into cloud computing, and their overall compounded returns are also really good. So that's why we have seen Microsoft stock going really high. Okay. So yes, it's a good time to invest in Microsoft, but not the entire dedicated amount. So if you had an amount in mind that, okay, I'll invest $10,000 in Microsoft, don't invest $10,000 in Microsoft right away. That's where your dollar cost averaging comes in. Let's say you invest, just 1 second. Let's say I go here. Okay. Let's say you invest here. If you have to invest $10,000, let's say you invest $3,000 right now, then wait for the stock to come down by 8 or 10%, right? Let's say from 182 comes down to 160 here, another 3,000. And then if it comes finally here, another 10% decline, looking at, right? Now this is what happens when you do this. You started with the buying price of this, but now because you did a dollar cost averaging, you did not put your $10,000 here. You put three here, and then four here, which means now your average price is somewhere around this. So even if the Microsoft price recovers back to 182, you will actually be in a profit. This is what dollar cost averaging is, and you can do this in a lot of stocks. You can do this in a lot of companies which you think have come at a discount. There are a lot of oil companies also which are down. Companies like Mastercard, companies like Visa. There are these companies which are still not at their all-time highs. If you have seen the market before the pandemic, these stocks were trading their all-time highs and they were rallying like anything. So always use the dollar cost averaging funda during these times, even in the bear market. So that is my agenda here, that even if it is a bear market, you can always put a lump sum now at a price and then wait for it to come down. So whatever was your dedicated amount, you divide it by 3 and you put it into 3 tranches at least. So 8 at 10% correction happens, so your average price improves. That way you divide your risk also. You do not enter, you don't have to time the market, plus you can be a part of it also. From here 182, if it goes up, you are still in profit. But if it comes down, then you can average it, right? So this is something which strategy can be done, and the entry exit levels can be defined to you by the advisor. So we'll look at the technicals. Let's see, this comes across like a good support line. For example, if I'm looking at let's say these levels, most of the time it comes here, it bounces back, right? You see these small dots here, comes down, bounces back, comes down, bounces back, again comes down, bounces back. See, right? So if it comes down again here or here, 131 or 140, buy again. This should be your last tranche. And I am talking about quality stocks. So it cannot be just any stock you pick. Microsoft is a cash-rich company. It's a $1 trillion company, large market cap. We are talking about blue chips here with good quality, with a good expectation in the future also, right? So these kind of things we can always do. One thing which is important is, see, we have to consider one thing, because dollar cost averaging, why, first and foremost, why it can be effective, it's like automatic. You know that this particular price, you can even put your limit orders, pending orders, it will keep buying on its own. Okay, just have to keep a look. But let's say if you have, if you're struggling to save consistently, if you're not able to save your money properly, or whatever is the portion of your income, if you're not regularly saving it, or somebody who make emotional decisions about investing, for them it becomes like a periodic investment. Okay. Somebody asked me, if somebody bought Microsoft at 140, should he book profits now? Absolutely, it should book profits now. If you have bought Microsoft at 140, you can easily book your profits. Those who have not entered can put little money, wait for it to come down and bounce back. Why I'm favoring the person who has bought at 140? Because if you're bought at 140 and Microsoft is at 180 now, that means you are looking at a growth of easily 20%, 20-25%, 20-25% or 30% growth on your portfolio. I'm not sure what is the duration of it, but last when I checked, Microsoft was 140 in February, in March. That was 1 month. If you're getting 25-30% in 1 month, just book your profit. You already are done for the entire year. I don't think you should even trade more than this or invest more than this. Guys, profit booking is really important. S&P 500, a global benchmark index, gives you an average return of 14 to 15%. Average, normal, 14 to 15% a year. If you are outperforming the benchmark, making a 25-30% return, then you are actually doing a good job. Book your profits and stay put. So be a part of the market. And also, it depends a lot what is your approach. If your approach is further long term, then hold it, because Microsoft is a good company. It will continue to go higher. But if you're looking at a point where should you book profits in a shorter period of time, you should, because dips will happen again. Take the advantage of the opportunity. Right now, the pandemic is there, vaccines are still not there. There will be frequent dips which will continue to come. Okay. So for those people who have not entered, you can start with a smaller amount to put into Microsoft. If it comes down, buy more. If it comes down, buy more. And then if somebody was bought at 140 and now it is at 180, book your profits, wait for a dip, and then enter. Right? So it is situational. It is a lot depends upon your risk profiling also. A lot depends upon your the size of your funds also. Okay, somebody asked me, what do you do after booking profits? Re-enter at what stage? Now, see, once you have booked profits in Microsoft, look for other companies as well. Okay, try to find out the same quality type companies which are at a undervalued. Not all tech stocks are at all-time high. Microsoft is at all-time high, but not all tech stocks are at all-time high. If you see on the likes of Alphabets or say, for example, Mastercard, or mobile payment, something like Visa or Mastercard or PayPal, these stocks are not all-time highs. So you can always try to enter those areas. We will learn something about what we call it as share baskets, okay, which will give you a much better understanding of what I'm telling you. So when we are looking, if you buy now and if the markets go up, then the price of your investments, it goes higher. But if it comes down, then you get an opportunity to clear your average price, right? Again, as I said, entry and exit points, you can point it out yourself or talk to your advisor, seek professional help, and they will be able to tell you what is the right time to enter as well, right? Show us the Mastercard or Alphabet to understand. Okay, I will open a Mastercard chart as well. So this was Microsoft. Let's understand Mastercard. Okay, look at the Mastercard chart. Here, and I'm looking at again 2 years data. If you see, most of the stocks will have this graph, came down, bounced back. So when it came down here, this is where the volatility index has peaked and markets have bottomed. Now it has recovered from there. Now, if you see Mastercard, just to be very careful here, if I have to even draw a line of support, and it's a long-term trade again, so I'm looking at, let's say here. So this is one support here, right? From here, mostly it bounces back. If you see these points, and again, guys, this is a technical analysis, obviously fundamental analysis, which involves the balance sheets, the cash flows, the PE ratios that will also be taken into consideration before you are picking a stock. So if you see something here, see here, 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 and this, and now see what happened here. So what is a support line? A support line is when it pushes to reaches to the support line, bounces back. But once this support is broken, then you see a big decline. So that's why this becomes an important support. Now, if you see, it is here, 274. So even if you buy first tranche over here, you are very much closer to the support line of 260. A profit booking, this Mastercard was 346. Right now it is 272. So even if you buy here, you can again resume buying at 259 levels or wait for it to come down at these levels. Look at the another technical support here. Somewhere around these levels here, which is 241. So 272, 260, 240, things like this. Again, looking at Microsoft, if it comes down here, from here, even if it bounces back to 272, you get the benefit of the dollar cost averaging. Again, guys, it is not something which is a sure short return, but it is way better than you putting your entire money, because I told you that, buy now. If you put your entire money, it comes down, it'll be like you told me to buy. I am telling you to take advantage of the opportunity where most of the stocks are available at a discounted price. It's like a sale, but you do not put your entire value in it. Do a averaging, do a dollar cost averaging where you put little money now. If it comes down by 10% or 8-10%, buy another tranche. If it comes down by another 8-10%, buy another tranche. Right. Similarly, I'll show you the chart for Alphabet also. In 1 minute, the US market will also open. Looking at Alphabet stocks right now. Alphabet is a much more expensive stock than Mastercard at this point of time. The value is $1,350. Alphabet was 1550, right? See, I told you every stock has a graph like this and this. Obviously, there are a lot of stocks which have recovered, but that doesn't mean that the dip will not be there. But then companies like Alphabet and Microsoft and etc., they have already been to one of the most highest points. So now if you see a decent point for Alphabet, without a doubt, I'm sure many of you are I'm looking at the last 3 years chart. This is a very good support line. I think everybody would agree with the point where you can see this line here, right? And if you see, even the pandemic crash which happened followed the technical and it went to 998 and bounced back to 1300, right? Also, if I'm looking for any other support, that can be this, because this is the another resistance which we have seen. So over here, when it comes down here, and again here. So maybe somewhere around this price level or here, 1279, right? So you need to take, now this is where everybody would have been thinking, oh, markets are going down, markets are crashing, should I be a part of it, should I not be a part of it? But then you see it recovered. So that is how normally you try to understand, not every stock all the time is a good time to buy. You have to time. If right now it is already 1360, high is at 1500, I will not ask you to buy here. Wait for it till it comes down to 1279 or till it comes down to a lower level. Markets will take a dip after all. Etsy Inc. and PayPal. Somebody is asking, okay, what is the minimum investment surplus required to start? So see, at our end, if for us, we have limited advisors. So for us to provide you an advisor, the minimum to begin with is $10,000. That being said, again, because I have limited advisors, so we have set up a benchmark for all the equities. You can put more money. I will try to show you how the trading happens. It's a leveraged account, so you will see that you can trade more than your initial deposit. But then again, that is something which need to be very carefully handled. I'll show you chart for PayPal and Etsy as somebody asked me to. So let's see for PayPal, for example. Okay. PayPal is already opened at a gap right now. If you see, it closed at 130, US market has just opened and it has opened $10 higher. Now, if I go, this is an all-time high. This is up by 11%. See today, it is up by 11%, 142. And this also during pandemic. Look at the support level prices over here. See, right? So now PayPal is already high. Now you must be asking, should I enter into PayPal now? Now you have to understand why the stock has gone up higher, because technically it is all-time high. There is no resistance and support. All records broken. So mobile payments or digital payments, normally what we call it, 70% of the transactions happen, which happen in the world, 70% of transactions, it happens in cash. And this is the time when digital payment or digital payment gateways will be needed more than ever. So we are looking at companies like Mastercard, Visa, PayPal, and the entire basket. So only in this platform, you will be able to find, when you go to the product library, something called as share baskets. Okay. Share baskets gives you a diversified exposure into a particular theme. So many of you have seen stock market index. Index shows you, if you see something like S&P 500, it shows you 500 companies clubbed together, but different sectors: tech, pharma, sports, merchandise, food, beverage, etc. But if you see, okay, I think guys, if you're not able to hear me, or if anybody has trouble with the audio or video, we'll try to again, please make a note of your questions, and we will try to get back to you over the call, and we can have a one-on-one session also where we can discuss further this. Okay. I think this is a network issue. It is happening a lot these days. So only in this, if you see, there is a share basket which is completely based on theme, which means if I select 5G, now, if I select 5G, 5G basket has companies like uh, Qualcomm, Vodafone, Verizon, all different kinds, around 20 companies in this particular basket. And there is a value which goes up and down depending on the performance of those companies. See what is happening here. Mobile payments, it is up by 3%. And obviously, because out of this, PayPal is up by 11%. So mobile payments have companies like PayPal, Visa. So it's like a share basket which is divided into different themes: big tech, cybersecurity, driverless cars, gaming, mobile payments, renewable energy, streaming. Streaming has companies like Netflix, Disney, right? The ones with the video streaming. So the bifurcation of all these can actually, you can use, your advisors can tell you that, okay, these are the companies which are in these baskets, we can trade into this, right? Now also, let's try to understand the very basic thing. How do you diversify it? Okay. This is a leverage based platform, which means when you open your trading account, when you transfer the money, you can see your money here. This is a demo account, so I have put $100,000. It's up to you how much money you want to put in this. Let's say now you want to do a diversification of this, right? How do we diversify? First of all, there are a lot of things which you can do on online derivative based platforms, where you can do short selling, where you're expecting prices to drop, and you can borrow the commodity from your broker and sell it live in the market. And when the price comes down, you buy it back and keep the price difference while the commodity goes back to the broker, right? How do I get the screen? I'm only going through the mobile IBKR app, which looks much different than this. So we are introducing partners to two different platforms. One is IBKR, which is interactive. So that's a different platform. This one is belonging to CMC Markets, which is normally has derivatives in it. So what we can do is, for IBKR, we can have a separate session, and one of our advisors can be in touch with you, and they can explain it to you, because IBKR will not have the same leverage which this particular platform will have. So just go sit through this session and try to understand this platform. Maybe if you like this, you can always segregate a bit of your investments into this particular platform also, right? Now, what we'll do, we'll try to understand how short selling works. We'll try to understand how leverage works very quickly. These are your asset classes. Commodities, these are the natural resources, what we see. Natural resources like metals, agriculture based. So rice, wheat, sugar, coffee, cocoa, this is your agriculture based commodities. Then there is your precious metals like gold, silver, platinum, palladium. Then there are your energy based: oil, natural gas, low sulfur gas oil, gasoline, all these oil products, right? So these are your commodities. Comes next, cryptocurrencies. When you look at cryptocurrencies, you're talking about Bitcoin, Ethereum. Guys, if you're diversifying ever, please do not make cryptocurrencies as a part of your portfolio. Cryptocurrencies, if you have, it's at best a good instrument to speculate around with. but it is not something with which you invest for a long period of time thinking that, okay, this is going to make a lot of money for my child, or this is going to make a lot of money in the future, right? It has no intrinsic value. It can literally go to zero anytime. So next is your, if you have to risk it on day trades, rather than cryptocurrencies, you can do it on currencies. Your actual forex. We are talking about dollar, yen, pound, euro. At least the movement of those currencies depend on central bank meetings, industrial production, inflation data, non-farm payrolls, GDP data, everything, right? Then comes your forex indices. So how an index works, index gives you a diversified exposure in multiple asset classes. So if you're looking at apart from US, which other markets do we support? So apart from US, there are a lot of markets, German markets we are looking at, UK markets we are looking at. There are some funds also which are related to emerging markets. There is a currently, I think, a sell-off in emerging markets, but there are funds which gives you an indirect exposure in emerging markets also. So we have in lot of indices. So if I go here, you'll be able to see Australia, Canada, Europe. We are looking at Hong Kong, India, Netherlands, Norway. These are all stock indices which are available. South Africa, Spain, Switzerland, Taiwan, UK, US, and different kinds of indices. Today you see everything is green because I think markets have opened up higher. So all the stocks we were talking about, even companies like Microsoft or PayPal, we are looking at, it's already 144, 12% up while we are talking. Look at Microsoft already 183, right? This is right here. It is up by 0.6%. So a lot of products, you can find it in your product library. These are your indices. Then comes your share baskets, and these are different sectors. Your advisor will be able to tell you which are the companies which are clubbed together in the share basket. Okay, so you will be able to take your decision that if, for example, if in a big tech, so big tech might have companies like Alphabet, Microsoft, Apple. These are good companies, right? So you can invest into a big tech basket. This is something which you will not find everywhere because this is a product created by CMC Markets, your broker itself. So they have clubbed together and they have introduced these share baskets. Then these are your individual shares, which normally you can trade. Mastercard, Facebook, PayPal, all the stocks which we have been talking about here. So you can always select a sector for yourself, or you can always look into, let's say I'm looking at IT, for example. So you can always see the percentage change, the biggest gainers, biggest losers here. See the biggest gainers. PayPal is on fourth with 12%. Then there is Fortinet, there is Bottomline, there is Twilio, there is GoDaddy, Cloudflare. So all these stocks, again, on the basis of fundamentals and technicals, you can always check with your advisor and they can assist you. Now, very important thing, if I have to take a trade, if I have to take a trade and I'll take, for example, Microsoft here. Okay. Now, if I'm looking at a Microsoft stock and if I want to buy it, most important thing about this platform is the leverage. If I have $100,000 here, this is my cash, 100,000. If I buy one share, it is equal to $183. If I buy 1,000 shares, it is equal to $183,000, right? I have $100,000 here, which means if I'm buying $100,000 worth stocks, the number of shares will be calculated for me, around 544 shares worth $100,000. One important thing which you will see, let me click buy. I click, order gets executed in real time. Now I have to see what I have traded. I will go back to positions. So I have bought Microsoft, 544 shares, $100,000. This is my buying price. Now there is something called margin, which says 5%. You see right now there's a profit of $70. So your account value is up 100,070, which means whatever money you put, your account value will show you the real value of your investment. Right now, if I'm making $100 in this, my account value is up by $100. If I'm losing $200 in this, my account value will be lower by $200, right? Now, the most important part is what we have done here. We have bought shares worth $100,000. But that being said, I had $100,000 cash with me. But from that 100,000, only 5,000 is blocked or held against this particular trade from my total money of 100,000, and rest 95,000 is my free or available cash. Just imagine a transaction which happens in a real estate. Let's say you want to buy a house here in UAE, say $500,000. You have $500,000 in your bank account. But how many times you think, okay, I'm going to take entire cash and I'm going to buy this house on the entire cash? No. What you do, you introduce the debt element by asking for a mortgage. You pay a down payment, you get a mortgage, you pay an installment. This way, your liquidity doesn't get hampered, right? So, and plus, you can use that money to invest somewhere else. Exactly the same concept it happens on this platform. That if you want to buy Microsoft worth $100,000, you don't give the entire money, just put 5% of the total trade value. Your trade value is 100,000. The percentage which you give is 5%, which is $5,000. So from your 100,000, 5,000 is blocked as margin. Rest 95,000 is your available equity, on which if there is a profit, it is being added to your account value. If there is a loss, it is taken from your account value. Anytime you decide to book your profit, your margin comes back with your profit. If you decide to book your loss, your margin comes back, but the amount of loss gets debited, right? Right now, if I have a profit of $140, $130, you see my account value right now, 136. This is a very important thing, because now the next question in your mind is that I bought, if I have put $100,000 in my trading account and I have bought Microsoft shares worth $100,000, but only 5% of the total trade value has been taken from my account, then what I do with the rest of 95? Can I trade with it? You can actually trade more with it. You can invest into different asset classes. So if you want to say now buy Microsoft, you bought, let's take example of, okay, Adidas maybe. It's a European stock in Germany. It is 209. Let's say I want to buy $100,000 worth Adidas shares. Margin blockage $5,000, 440 shares. I buy now. Now I bought Adidas also. Now the value of my portfolio is 200,000. I just put $100,000. This process is called leveraging the portfolio. Okay. You still have $90,000, which means you can actually trade more. What I'm trying to tell you is if you have put $100,000, you can take trades worth million and more, but that will become very aggressive. Okay. So if you are going so aggressive, then it is not beneficial. Because if you're going this aggressive in a $100,000 account, if you have a $2 million, $1 million position, then when market starts coming down, you will have to keep adding more and more margin. Otherwise, automatically your trades will be closed. So for a clear understanding of this, you can talk to your RMs and they will book a one-on-one session, and we can always have these sessions, so your RMs can have one-on-one sessions with you and they can explain you how this works. Somebody asked me for the charges for providing the leverage. So leverage as a financing cost, if you're buying stocks, then the financing cost, it is dependent on whatever the LIBOR is. So LIBOR is the interbank rate between one bank to the another, which is decided by the top tier banks. On the basis of that, currently the LIBOR is there around 1.1%. So if you are buying shares worth $20,000 and you're holding it for one night, so 1.1% or 1.2% of $20,000, that is say around 200 divided by 365, somewhere around 80 or 90 cents on a $20,000 position you will pay overnight. So this is again based on LIBOR. A proper understanding of this, when you look into the platform and you open the account, you will see it, and your RMs can also give you a demonstration of how it is charged. But it is competitive because there is no broker markup added in it. So you're only looking at the LIBOR, and world interest rates are already lower. So you can get an opportunity to use the leverage with a very lower LIBOR. That being said, please do not go aggressive if you are not properly aware about how to take the leverage. In a $20,000 account or in a $10,000 account, if you're a conservative client, do not take higher trades than 20,000. If you are a balanced investor, you can take some chances, then do not take more trades than 40,000, 3 to 4 times. If you're an aggressive investor, you would go higher, but your risk and reward both will go high. So please do not do something which is very insane, because it will take just a click of a button to turn this investment into a gambling mode. So we don't have to do all this. The idea is maintain a very proper portfolio, diversify your portfolio into long-term equities, short-term trading speculations, where you can also keep a stop loss and take profit. Now you are not going to see it all the time what is happening. What you can do is anytime you can keep a stop loss and take profit. So I click here, I put a stop loss that I don't want to lose more than say $600 in this transaction, plus I want to book a profit of 1200 whenever it comes. So I modify this. Now I have a price. Whenever Microsoft reaches to 185.99, my take profit will get hit. If it comes to 182.68, my loss will get hit. Whichever comes first, other will get cancelled. So these kind of things are there in the platform. Plus, there is an advisor. Talk to your advisors. Don't get scared of the markets, because volatility is a part. It's a new normal. If you see out there now, you will see people wearing masks and walking around, right? Offices are opening. Obviously, it's a different argument whether it is safe or not. Let's not fall into it. But what happens is, or a much more positive example, we are doing this. We are doing our meetings on Zoom. We are using webinars. We are doing work is not stopping, because everybody's finding out a way to connect to each other. Remote communications, Zoom videos. Zoom also has a stock, by the way, which is tradable, and it has moved very high. So the world goes on. If you think that this is the end of the world and why to invest now, and it will crash, that is just a mindset. That is an outlook. But we cannot, even if it is going to happen, we cannot think about it and not invest and just keep the money with it. Invest. Don't invest into things like Bitcoins and Ethereum just thinking that right now it is at the lowest end. Try to invest into businesses, invest into companies. Right now, for example, this is 200,000. If you had $200,000, you could take a trade worth 200,000. Do not take leverage. Just take an equal trade, right? Whatever is your profit, it reflects here on your account value, right? Similarly, there is also a way to make money from the falling markets, to take advantage of the falling markets. Okay. How do you take advantage of the falling markets? Very quickly, I will finish the short selling thing, and then I will just give you a brief outlook of what is happening in a couple of stocks which we have decided, and then we can end the session. Short selling means you can actually, so for example, if you're expecting Boeing, let's take example of Boeing. Nobody's traveling these days. So let's say if you're expecting Boeing stocks to come down, what I will do is I will quickly try to find Boeing. Okay, here it is. Second. These are Boeing stocks. Let's say if I'm expecting it to look at the fall in Boeing, 345 and came down to 195. The planes industry, and then it went up to 185. From 95, 85, it went to 185, and then came down again to 125, 155, and now it is 124. Let's say I'm expecting it will come down. What I do, if I'm expecting it to come down, okay, right now see they have said shorting not allowed because it went so down. Okay, let's take example of Apple. Maybe Apple is 304C, almost recovering back. Now let's say if I'm expecting Apple to go down, what I can do is instead of buy, I can select sell. Now I am buying 1000 shares, or instead let's say 100 shares from my broker to sell it at 304. Just try to do a math in your mind that if you sell something, you receive money, right? So if you borrow shares from me and you sell in the market, you will get money, right? Now I'm doing exactly the same thing. I'm borrowing this from my broker, selling 100 shares at 303. I place the order gets executed, and now I can see Adidas buy, Microsoft buy, but Apple sell. What does it mean Apple sell? I have borrowed 100 shares of Apple from my broker and I have sold it live at 303. Imagine if you sell something, you get $303, right? If you're selling Apple shares at 303, you are getting 303 per share in your account. Imagine if Apple share goes to 293, down by $10. You go back to the market and you buy it back at 293. So the 303 which you received, you pay 293 from there, $10 you're left with, this is your profit, and shares you bought it back, you give it back to your broker. How short selling works. So you are actually able to take advantage from the falling markets also. So for those people who think that markets will crash and it might come down further, you can actually short sell the US stock index, or you can short sell any stock. You can short sell gold, currencies, commodities, oil, anything you want to. So there is a way that you can take advantage from the falling prices as well. Last but not the least, somebody asked me about the event-based trading. So something called market calendar is in the platform. Okay, the market calendar shows you the daily economic data which comes. So the daily trades are based on economic data, GDP data, industrial production, retail sales, unemployment claims, non-farm payrolls, which is the private jobs report. Some of them are very crucial. So what you do, first select the most high impact news with the three red dots, right? Now see, today's news have already come. Tomorrow is Friday. The most important news is going to be tomorrow evening 4:30, the private jobs report and the unemployment rate of US, which will tell that how many kinds of how many jobs have been generated in US in the private sector in the previous month. Now, when that news comes in, it will affect US dollar, it will affect gold, it will affect other currency pairs, it will affect US equities also. And obviously, it is expectation that the non-farm payroll, the private jobs report is going to be very poor because unemployment rate has been high. Maybe markets have already discounted it, so maybe there is not much movement. But event-based trading is all about this. 4:30 news is about to come. You be there at 4:30. Try to take a trade in gold, but keep your stop losses and take profits. Event based trading is specifically for short term investors, day traders. And you should always have a stop loss and take profit. Do not take a open trade in currencies or commodities. Okay. Please remember this. Currencies and commodities, if they go on a different downtrend or an uptrend, it can continue that for a long period of time. Now, very quick, if I see it here, see my positions right now. So now, see, this is where you diversify. I've just invested into two asset classes, Adidas and Microsoft. I've still not bought, say, Euro USD, for example. If I'm looking at Euro USD, now see, how do you diversify? This is down. Let's say I will buy 20,000 Euro USD. Everything is being done on margins, right? And then I will go to an agro commodity, let's say wheat. I go to wheat and let's say I short sell $20,000 worth wheat, expecting prices to come down. Again, no research, nothing. I'm just doing a very random trade here. And then we go to US 30. And let's say US here, US 30, which is your US stock market index. And let's say I select a buy and buy worth 20,000. Right. And one commodity as in gold. Select gold here. Gold is 1698. Let's say I'm buying gold also worth, or let's say selling gold should do come down. Sold it. What I did, I just take random positions right now. But what you need to see is even when you are taking random trades and different asset classes, first you need to carefully see your exposure. In $100,000, I've taken worth 300,000. Still conservative, leverage 2 times. Plus, I will keep a stop loss and take profit in indices and commodities and currencies. Shares, if I want to go for long term, I'll keep my leverage lower and will not keep a stop loss. But that depends upon individual's risk profile. Uh, Somebody is asking me the next event is tomorrow. So what do you suggest for buyers? I personally feel that the non-farm payroll right now is heavily discounted. But one thing, so I will combine the outlook for the instruments with this question. I think gold is on a very bullish side, which means we are expecting gold prices to go higher. One important thing is this, that the economic data is very weak. There is an uncertainty about pandemic. The world central bank interest rates, all of them are kept at a lower price. So I think gold is a decent buy at these levels. Again, whatever recommendation I'm doing, please keep a stop, take profits. Also, see your individual risk before you go ahead and take any trade. Okay. Then we are looking about oil. Oil is something which will be range bound because the demand slump is not getting better anytime. The output is not being cut at at a very high rate. So we'll still see oil prices in a range. If it goes up, it will not go. It may not go more higher than 34 or 35. On the other hand, it can come down to 18 and 20 levels easily. There is no as rally as expected. If you want to invest into oil, want to take exposure into oil rather than investing into the direct commodity, I would suggest you to take positions in oil companies like Schlumberger or Total or ExxonMobil or Chevron, good quality companies which have good dividends also. So if let me show you here in the product library here. So you can go to your product library. You can search for just reset this. Go to shares and then go to energy. You can select your sector. Energy is your basically energy based companies here, 339 total. And let's say go to US. See US energy sector. You see companies like Chevron, for example, 3% up, right? Companies here. And if you see ExxonMobil also, see here, ExxonMobil up by 2% already. So if you see oil as a direct commodity, rather than investing into oil as a commodity, I would still suggest you. So you can select oil, you can see energy prices here. Today, see energy prices are up by 3 to 4%, right? But yesterday they were down by 5 to 6%. But the stocks, they have a consistent movement. So that's why gold is bullish. Euro is still expected to be downside. A dollar is expected to be stronger because US-China tensions are still rising. Pound is still expected to be bearish because against dollar, pound is very bearish with the Brexit outlook and uncertainties. So I think gold at this point of time should be a decent buy because tomorrow's news is expected to be not to be very good. So that will weaken the dollar temporarily and will push gold prices further higher. Plus, there is an influx of negative corporate earnings also, which have pushed down many stocks and which have pulled up also many stocks. So if I talk about stocks, look into the oil companies like Schlumberger, Total, ENI, Chevron, ExxonMobil, Royal Dutch Shell. Most of these companies, these are oil majors, super majors, and they have good dividends also. So less volatility, high dividend. This is the kind of companies you want to invest into right now. Okay, a part of your portfolio can be into growth stocks, but then those stocks could be related to video streaming like Netflix, right? Because these are the sectors which are preferred. E-commerce companies like Alibaba, Amazon, video streaming companies like Roku, and some pharma companies like Pfizer or Regeneron or Novavax. There are a lot of pharma companies. These kind of sectors don't end up investing into travel tourism because it will take time before these things resume, right? So I think we have covered a lot of things in this session. Thank you so much once again for being here. You can always ask for demo accounts with from your RMs, and they can assist you in putting the trades. You can also have a one-on-one session if you want. We can always sit for a one-on-one session and we can try to explore the platform more. And if you have any individual queries also, please reach us out. More than happy to help. At the end of the day, this is the month of Ramadan. It's the month of giving. So we are going to have a lot of webinars like this. I think we have more webinars on similar concepts. Things are not going to change much. But if you have any individual separate questions, please reach us out. And thank you once again. I'll take your leave now. Please take the demo, read a little more. If you are already a client, then talk to your advisors. If you're not a client, take the demo. Just try to talk to your RMs and tell them to send you some nice research reports. We are creating a lot of research and it's coming on daily basis. So you can always talk about, you can see a lot of stocks and you can always invest. Just remember these things about dollar cost averaging. Remember about how to manage your risk, how to put a stop loss, how not to take a very high leverage, taking advantage of the falling prices also, right? So my name is Yogesh. Please, you can go back and also, okay, no problem. So thank you so much. Please send your feedback to your RMs and do subscribe to our Twitter and Facebook and LinkedIn handle. If you have any further queries, we'll reach you out. Once again, stay home. Please stay safe. I wish a really good health for everyone. Take care and be safe. Thank you.